Hey there, everybody. Juliette Wensler here with Remax Victory, and I am here today with Drew Huggins from Thrive Mortgage. Say hi, Drew.
Hello.
Awesome. So, I've been doing these interviews with just local business owners and just anybody who's in the industry, which obviously you are. You and I have known each other for, I don't know, 2.5 years, maybe.
Yeah, going on three.
Yes. Yeah. Oh my God. It is going on 3 years. So we've done quite a bit of work together over those 3 years. And I know you and I have been talking a lot about what's been going on with the coronavirus and just what's going on with mortgage rates. And that's something that's a big hot topic everybody wants to know about. You know that. So why don't you tell us a little bit about you, how long you've been in the business, and then just kind of what's going on with rates and how this is maybe affecting your business.
Yeah, thanks, Juliet. So I've been in the industry for going on 21 years. This June, it'll be 21 years that I've actually been in this side of mortgage. It's actually 22 years because I had a year in the bad side, what we used to call subprime. So I've been doing it for about 22 years. We Thrive Mortgage is new to the area, but we're not a new company. We've been around for 20 years. We came to Dayton in September of last year, and we have a location in Troy, one in Dayton, and now a new one down in Westchester.
Awesome. Okay, great. So over the last 30 days, have you seen a big difference in your business with buyers, or are you staying steady because the market rate or the mortgage rates have dropped a little bit? I know they haven't, from what I'm hearing, and you can tell us more, it's just kind of been chaotic with the rates. But from what I'm understanding, they're still historically low and they're staying historically low, but they're not at that, people are reading this 0% and 1%. That's not the case for mortgage rates.
Right.
So how has that affected you over the last 30 days, or has it? Are you staying steady with buyers?
It's been, so as far as purchase, that is down a little bit. So the stats are that mortgage purchase applications are down around 24% month over month.
Okay.
But mortgage refinance applications are up 115%.
Wow.
So rates are at historic lows right now, but we've had 3 weeks of some serious volatility that I've never seen and most of my peers have never seen in the industry. So where we would go on a Monday, we'd be in the low threes for a 30-year fix. By a Friday, 3 weeks ago, we were over 5%. So mortgage rates don't swing that much. It just doesn't happen. But it did happen that one week. Without getting into the weeds on why, as far as talking about the secondary market and everything, it's kind of in the background. So how the rates are created and how the rates are sold. It's a mortgage-backed security, and there's a lot of complexity as to why the rates have had some volatility. Some lenders like us have stepped in, and we've got, well, number one, I think cooler heads have prevailed. So stock market volatility is cooling off a little bit. And then we have a fantastic CFO who just knows the market inside and out and has been able to take away some of that volatility for us. Where it may be going on in the mortgage-backed security market, there may still be that volatility. He's provided us some confidence to be able to go out to our clients and talk about it. So yeah, mortgage purchase applications have dropped, but I think that people are getting restless again because now we're going on 3 weeks, right? 4 maybe, of a stay at home.
A little more than 4 weeks, yeah.
So people are getting restless, and so I had 2 contracts today. But I also had 6 people that came to me wanting to refinance today too. So I'm trying to help my prior clients. I don't do a ton of refinance. You really just help my prior clients and work with them on that.
Okay, awesome. Do you want to talk a little bit about the products that you offer, just on a regular basis? Because I know you do a lot of different loan programs. I do not have the virus. I have allergies, I swear.
So
I swear.
We do mortgage, the mortgage programs that we do are FHA, VA, USDA, conventional. So the mortgage programs, they're not as many as there used to be. Used to be that there were hundreds of different mortgage programs and all these little bells and whistles and all this stuff, and that's not the case anymore. So it's just basic government-backed mortgage and non-government-backed or conventional. So the government-backed mortgages have had some where we've seen most of the volatility because we've had some serious changes in underwriting guidelines, higher credit score requirements, reserve requirements, lower debt to income requirements. These are all probably the correct movement, the correct response to this volatility. And also because of the fact that there's going to be some people who are going to be without work completely.
Sure.
So we are requiring to verify employment a little bit more often. We're also verifying employment for self-employed individuals in a different way because a lot of those self-employed shops may not even be open.
Yes.
So that's, we've got to verify that they're still open, they're still getting business, and they still have income coming in.
Yeah, I've heard from several different people that if you're self-employed right now, it is getting maybe a little bit tougher than it would normally be. So do you foresee that all these changes that they're making right now temporary, or do you think these will be long-term changes to
So
how
I think,
they're, like
yeah.
2008, 2009, obviously a lot of things changed in the way that they were pre-approving people. Do you think this is going to be, changes long-term, or do you think this is just a temporary until we get through this coronavirus?
I think it's a good question. We have said that they're temporary because once people go back to work, we should see the economy start to roar back.
Yeah.
2008, 2009, we didn't have forbearance offer from the government or anything like that. So people just lost their houses. So there was a downturn in the market. There was a combination of strategic default, which was people who said, my house is not worth what I paid for it, so why keep making the payments on it, which was not very intelligent. The people that could make the payments that weren't. But then there were the people that couldn't make the payments. There was a lot of those. And values dropping when people had to sell, so there were short sales. So this is temporary. We've got the government stepping in to try to prevent some of that stuff from happening, closures. That was why it was long-term, because the mortgage lenders wanted to prevent anything from happening again. We will open up, whether it's May 1st or whether it's June 1st. People go back to work. And I think that the response is going to be roaring back, because I think that people like myself and you, we've talked about this, we're extroverts. And this is killing us to be at home. And so this is why we do this stuff to connect.
Yes.
So once we can go to restaurants, I think I'm going to be eating out every night.
I know.
It's going
to be bad. It's
going to be bad for wine.
I see, right? I know.
Yeah, so definitely. So what I think that's going to do is that's going to loosen once we see July come. I think that lenders will see there's a little bit more liquidity in the mortgage market, and when the liquidity comes back, the servicers and the lenders will release some of this tightening in the guidelines. Now, with that said, I've always been pretty conservative when it comes to my clients, and the debt to income requirements, the tightening the debt to income requirements have been something that I've recommended pretty much all along. Lenders can go much higher on debt to income than really is comfortable. So I've always counseled my clients that 50% debt to income, while it may be approvable, does not necessarily mean that it's the right thing. When I've recommended that is when there's other income that we can't use. So say, for example, you've got self-employed income, gig income. That's a big one. People drive for Uber or Lyft or whatever. We can't necessarily use that to qualify, but I know there's $1,000 a month for that. So So in a situation like that, then we can count that, or we can't count it, but we can say, okay, this is why it's okay to go that high debt to income. I don't know that that's ever going to or ever should come back, where you can go up beyond 50% debt to income without some strong compensating factors.
Mm-hmm.
There are certainly situations of people who walk into a home and they're strapped walking into it. They use every dime of their cash for the down payment, and then they have no reserves, and they've got a 50% of their income going for all their payments, and they're going to default. So some of this might have been just, okay, did lending get a little too loose again? But that's my humble opinion.
Right. Well, for those who might be watching this, who are, and you and I have dealt with a lot of these clients, do you have any just quick advice for those people who are out there who may be wanting to buy this year, but perhaps their credit score isn't where it needs to be? I know you've worked with several of my clients and just helped them. And one of the things that you told me, which I never really knew, was you said just in general, if you can get all of your debt to under a third, let's say balances, credit cards and things like that. I never knew that that's one of the easier ways that you could boost your score. Do you have any other advice for first-time home buyers or people who are looking at this right now going, okay, well, great, they're tightening everything up right now, but hopefully in 3 months, things will be back to normal. What can I do over the next, let's say 3 to 6 months to prepare myself if I want to buy a house?
And that's a really good question. So I think the big thing is to talk to, well, your agent, talk to you, then talk to somebody that you trust that knows credit. And so that's what I do. Like you said, I'll sit down and I'll look at somebody's credit, and if their score doesn't qualify today, I have tools, professional tools, and then also just my experience to look at everything, look at all their credit and say, okay, do this, this, and this. And then we can, then in 3 months, 6 months, 12 months, whatever it is. And then I just follow up. I'll continue to follow up and say, hey, have you done this stuff? I've helped people. Started talking to people, and it's taken them 12, 18 months of doing stuff. Mm-hmm. And I had one client who I still remember. She would update me every month. She said, hey, Drew, I paid this one down. Hey, I got this one taken care of. And then finally she came back to me a little over 12 months, and we were able to get her in a house. And that was what was exciting, is this first-time home buyer that cried at the closing because she was so happy because she got into this house that, I just took the time. And we're not talking about, this wasn't a $200,000 house. This was, right. I think it was a $60,000 house. She was overjoyed about it. And one of the first homeowners in her family, of her parents and her grandparents. And so that's why we do what we do, right? That's why we love it.
That's awesome. That's awesome. I know we had one lady, it was a couple years ago, maybe a year and a half ago, but I think it took her about 8 months, if I remember correctly. Mm-hmm. And she followed through, and you continued to follow up with her every month and check in with her. And she was doing everything that she needed to do. I think she was self-employed. So she needed that second year of tax returns. I think her credit score was fine, but you stayed on her and stayed in touch with her. And I found her a house, and again, she was a first-time home buyer too, and she was thrilled. And I think you just met with some clients, I think maybe Monday, and they're on track with you to work through, just getting some debt cleaned up and getting credit scores up and things like that. So the people who are serious about buying are the ones that are going to make that happen. And the conversation I had on Monday with a client, and she's young and they're first-time home buyers, but she said, my credit is not perfect right now. We know there's things that we need to do, but I'm really young. And I think if I learn how to do this now, I'll have these tools for the rest of my life. And I was like, that is huge. That's awesome. Because some of us, like even myself, I've screwed around with my credit, my whole life. And until the last 5 years, I didn't really pay attention to it. Well, now it's so easy. There's apps, you can log in and look at everything. It has made it a whole lot easier. So I think that's huge that you do that. And the other thing that she did say is that they had talked to another mortgage professional, and they weren't nearly as gracious as you were. So they were very happy to have talked to you. So that's awesome. Good service matters, Drew.
Absolutely. And I think that, so most everyone in my industry is great. And I'm fairly involved with the state mortgage bankers association and the local, but when you get busy, it can be very easy to push off those people that are quote unquote low priority, which I hate to say, but those people who have those credit challenges, they can be a lot of work, but
Yeah.
it's still taking the time to let them know that we care together between you and I, that we
Yep.
care about them,
Yep.
and that we want to help them to get, to achieve the American dream, right?
Well, and that's what a great CMA is for, right?
Yeah.
I mean, I can't remember everybody in my head. If they don't go into the CMA, I'm like, or the follow-up boss, CRM.
CRM, yeah.
I did a CMA earlier. That's what's on my mind right now. CRM, the CRM. If I don't put people in there, I'll forget about them. I can't do the notebook, I talked to so-and-so today, and 6 months later I'm going, no. If they do not go in the CRM and I put notes in there, and that's how I follow up. And I think you probably do the same thing.
I do. Yeah, I have to, because, somebody will come back to me and they'll say, hey, Drew, I did this, this, and this. And I'm like, awesome, good for you. I have no idea. So
Yeah.
I'll just go back into the CRM and say,
yeah,
oh, yeah, absolutely. I'm glad you did that. And never let them think that I had no idea what the heck.
Well, yeah. And I think there's a handful of those people that are going to be 6, 8, and 12 months. And if we don't have a system in place to continue to follow up with them, you're going to lose them completely. You'll lose track of them. And I think those are the people who need our help the most. And those are the ones we need to reach out to on a more regular basis. So I think you do a great job of that. Everyone I've sent to you has been very happy with your service. And I know that you've helped a lot of my clients just get through that. Let's get the credit score up. Let's get some of this debt paid off and get you a house. So awesome. Is there anything else you want to tell us, or anything about the coronavirus that with your business that comes to mind?
I think the big thing is this too shall pass, and I'm trying to tell everybody that.
Mm-hmm.
But I think that there's also the other side of it, is that so many people are focusing more on family and spending more time with family or their pets, like Luna.
Walking, yes.
So, and it's been really nice. I think a lot of people are really seeing and reconnecting. So hopefully, I think a lot of stuff is going to change, be a little bit of a cultural change for us. And I think at the end of the day, looking at the positive side, and it's a good thing. But yeah, the mortgage industry I think that everything changes for a reason. I think the mortgage industry will change with this. It's not going to go back to the way it was, but I think that it's going to go back to pretty close to the way it was before. But I think that industry experts have also realized that maybe the rails are off a little bit too much because of everything that happened over the last 3 weeks in the mortgage industry. Is just like, okay, wait a minute, what just happened? And so I think more people are going to, again, back to the cooler heads, I think that they're going to say, okay, let's prevent this from happening again.
Yeah, for sure. Well, thank you so much. Excuse me. And I'm not kidding you. I have allergies. I've been taking allergy tabs every day, and I didn't take one today. I did not have the virus, I swear. But thank you so much for your time, Drew. And if anybody is interested in connecting with Drew, you can reach out to me, or you can Google Drew Huggins at Thrive Mortgage. And I will also put his information in the post, so you all know how to find him. Thank you.
Awesome. Thank you very much for your time, Julia. I really appreciate it. And I
think I'll see you on another Zoom call again today.
I think so, a little bit later.
See ya.
All right, bye.
Bye.